Hi, I'm Richard Vague with Tycos. A couple of weeks ago, when the Japanese stock market briefly stumbled, we took you through a conventional analysis that suggested that U.S. and Japanese stock markets were both fully valued, and while stocks go up and down, we thought that in the short term, stocks were more likely to go sideways or down rather than up. I'm not talking about day to day, I'm talking about over the course of the upcoming year. Today, we want to take an unconventional approach to that same analysis. It's a different approach that we ourselves use, and it suggests that while stock values are high, they might not be quite as high as implied by conventional analysis. The unconventional measure we use is the ratio of stock market value to the money supply, or M2. As you can see here, for both countries, using that measure, stock market values are high, but they're short of all-time highs, especially in Japan. So why would we compare the stock market value to M2? Simple. M2 is the measure of how much money there is in the economy, and the more money there is, the higher asset values go. By the Fed's definition, M2 is almost entirely comprised of deposits. So we will be saying the same thing if we simply say the more deposits there are, the higher asset values go. Here's the thing. Stock values have correlated more closely to M2 growth than to either earnings or GDP. Now, let's think about that. Stocks are supposed to relate to earnings, and we're saying stocks relate more to deposits or fit more closely over time in the sense of correlation to deposits than they do to earnings. It's, I think, a fairly profound and fundamental thought. Stocks and real estate are the big two assets in any economy. Households have a net worth of $151.6 trillion. That's $171 trillion worth of assets, less $19 trillion of liabilities. And 79% of those assets are real estate and stocks. So almost 80% of our household wealth boils down to stocks and real estate. And the more deposits there are, we are saying, the higher the values of these two asset classes go. That should make intuitive sense, since the more deposits there are, the more buyers you'll have, and the more money they'll have to buy assets with. More money means more buyers, and more buyers means higher prices. There are obviously a lot more factors at work here than just deposits, but we should take at least some comfort in the fact that stock market value to deposits is below its all-time peak in both countries. As an aside, most deposits are created by bank lending, not the Fed's open market operations. And that's a phenomenon that's easy to track in the Fed's own quarterly reporting of the national balance sheet. I think over the broad course of time, 80 to 90% of all deposits have been created by bank lending as opposed to Fed open market operations. As regards the stock market itself, we can never talk about it without reminding our friends that stock market corrections of 10 to 20% are not uncommon. But if they're stock market only corrections, they tend to bounce back very quickly, usually in less than a year. And we can also never talk these days about it without mentioning that our nagging concern is the impact of wider wars, potentially on oil prices. Nevertheless, using our unconventional method for assessing the stock market, stock values are high, but not above their former peak. That's it for this week. Thanks for tuning in. And if you have a topic that you'd like for us to cover, let us know in the comments below. Thanks.